Everywhere you look, the numbers tell the same story. Governments owe staggering sums. Corporations owe more than ever. Households are locked into decades of repayment. The United States carries tens of trillions in obligations. China, Japan, Europe, all deeply indebted. Add it all together, and the total climbs into the hundreds of trillions of dollars. More debt than the world produces in years. More promises than output. More claims than reality seems able to satisfy. This is usually where the conversation stops. Commentators argue about interest rates. Politicians debate budgets. Economists warn about sustainability. But almost no one asks the most basic question of all. If nearly every major economy is a debtor, who exactly is on the other side of that balance sheet? Debt is not abstract. Every liability is someone else's asset. Every dollar owed is a dollar owned. If the world owes hundreds of trillions, then someone, somewhere, holds hundreds of trillions in claims. And those claims generate income, power, and influence. Understanding who holds them is not a technical exercise. It is the key to understanding how wealth concentrates, why inequality accelerates, and why the system behaves the way it does during booms and collapses alike. To see it clearly, we need to step away from the way debt is explained to ordinary people and look at how it actually functions. In the modern monetary system, most people understand debt through personal experience. You borrow money, someone else had savings. You pay them back with interest. That mental model feels intuitive, but at the level of governments and global finance, it is deeply misleading. When modern governments borrow, they do not draw from a fixed pool of pre-existing money. The act of borrowing itself brings new money into existence. Bonds are issued. Central banks and commercial banks purchase those bonds. Balance sheets expand. Numbers are credited. The money did not exist the moment before the transaction. It exists because the debt exists. This is not speculation. It is how the system is designed. When a government runs a deficit, it creates bonds. Those bonds are bought by financial institutions that can create money through accounting operations backed by legal authority. The result is new currency entering circulation alongside new debt. But there is a critical asymmetry built into this process. Only the principal is created. The interest is not. If a government issues $1 trillion in debt, $1 trillion appears in the system. But the obligation is greater than 1 trillion. It includes decades of interest payments. Those payments must come from somewhere else. Future borrowing, higher taxes, or economic extraction. This creates a structural condition where total debt must always exceed the available money required to settle it. The system cannot close its books without expanding further. Stability requires growth. Servicing requires expansion. Stopping is not neutral. Stopping is collapse. This is why global debt has grown faster than global production for decades. It is not merely excess spending or political irresponsibility. It is a mathematical consequence of how money enters the system. Once you understand this, the question of who holds the debt becomes more unsettling. Because the holders are not random. They are highly concentrated. At the foundation are central banks. These institutions sit at the core of the monetary system, purchasing government bonds and stabilizing markets. They hold enormous quantities of sovereign debt. Their role is often described as public, neutral, technocratic. In reality, they are hybrid entities designed to serve both state financing needs and private financial systems. Central banks earn interest on the bonds they hold. That income does not vanish. It flows through institutional structures that ultimately benefit financial sectors and asset holders. The mechanics vary by country, but the direction is consistent. Public obligations generate private income streams. Above this layer sit institutional investors, pension funds, insurance companies, mutual funds, asset managers, and sovereign investment vehicles hold a vast share of global debt instruments. These entities appear broad-based, but control is narrow. Pension funds technically belong to workers, but workers do not set policy. Professional managers do. Their compensation is tied to assets under management and returns, not to wage growth or social outcomes. Insurance companies are pulled around. Asset managers answer to investors who already possess capital. Ownership of these institutions is heavily skewed. A small fraction of households owns the overwhelming majority of financial assets. When bonds pay interest, that interest flows disproportionately to those at the top of the wealth distribution. Another layer consists of governments holding each other's debt. Trade imbalances create surpluses that must be parked somewhere. They are often recycled into foreign bonds. This arrangement stabilizes trade flows but entrenches dependency. The benefits accrue to state elites and financial authorities, not to average citizens. Finally, there are private individuals, family offices, dynastic fortunes, and ultra-high net worth investors. For those with vast wealth, lending is not a necessity. It is a strategy. Bonds provide predictable income, legal priority, and insulation from volatility. Large portfolios generate cash flow without labor. Interest becomes a permanent claim on the productive economy. Taken together, these groups hold the majority of global debt assets. And while they differ institutionally, they share one defining characteristic. They are already wealthy. The bottom half of humanity holds little to no financial assets. What they hold is obligation, mortgages, student loans, consumer credit, taxes that service public debt. Their role in the system is to pay. This is not new. Versions of this structure have existed for centuries. In medieval Europe, religious institutions and merchant banks financed monarchs. In return, they received land, privileges, and interest streams that compounded over generations. Lending proved more durable than conquest. Armies disbanded. Debts endured. In early modern Europe, state-backed banks formalized this arrangement. Governments gained access to continuous financing. Bankers gained guaranteed income backed by taxation. Public debt became a permanent feature rather than an emergency measure. Over time, the system globalized. Financial networks expanded. Capital became mobile. Debt instruments became standardized, tradable, and abstracted from the lives of those who ultimately paid for them. What remained constant was the direction of flow. Interest moved upward. Obligations moved downward. Wealth accumulated faster for those who lent than for those who worked. The power of the system lies in its invisibility. Interest is embedded everywhere. In rent, in prices, in taxes, in wages that rise slower than obligations. Most people never see the full amount they pay. It is fragmented across daily life. The scale becomes clear only when aggregated. Trillions transferred annually from borrowers to lenders. A steady stream that does not require innovation, risk, or production from those receiving it. This income compounds. Those who receive interest reinvest it. New claims are created. More interest flows. The gap widens not through effort, but through structure. Crises do not reverse this process. They accelerate it. When downturns arrive, debtors fail first. Assets are liquidated. Prices fall. Those with liquidity and claims step in. Ownership concentrates further. This pattern has repeated across depressions, recessions, and financial shocks. After each collapse, the narrative changes. Regulation tightens. Safeguards are promised. But the core mechanism remains intact. Debt is preserved. Claims are protected. Losses are socialized. Gains are retained. The system presents itself as inevitable, as technical, as too complex to question. But complexity does not mean neutrality. Design choices matter, and the design consistently favors creditors. There is a limit, however. Debt cannot grow faster than real output forever. When obligations outpace productive capacity by too wide a margin, adjustment becomes unavoidable. History suggests three broad outcomes. Defaults, where obligations are erased. Inflation, where obligations are diluted. Or restructurings, where terms are rewritten. Each path redistributes wealth. And in each case, those with diversification, mobility, and assets tend to fare better than those with fixed incomes and localized exposure. The system does not collapse suddenly. It strains. It fractures. It shifts burdens. Those at the top prepare in advance. They hedge. They diversify. They influence policy. For everyone else, adjustment arrives as surprise. This is why understanding who holds the debt matters. It reveals who benefits from continuity, who absorbs the cost of expansion, and who is protected when correction arrives. The global debt system is not merely about money. It is about power, about claims on future labor, about who gets paid first and who waits last. When you ask who the lender is, the answer is not a single institution or family. It is a class defined by ownership of financial claims. A class that lends as a function of already having wealth. A class that receives income not for producing, but for owning. That is the mechanism. It does not require conspiracy. It requires only arithmetic, law, and time. And as long as the system continues to create money through debt, while demanding repayment with interest, the direction of flow will remain the same. The unresolved question is not whether this structure concentrates wealth. It demonstrably does. The unresolved question is how long it can continue before adjustment forces a change and who will be prepared when it does. That is not an economic question alone. It is a question about the future distribution of ownership, security, and autonomy in a world built on promises that mathematically exceed what can be delivered. And that is why asking who holds the debt is not radical. It is essential. Because once you see the balance sheet of the world clearly, you realize the system is not broken. It is working exactly as designed. At Finance Matters, we explore history, economics, and perspective without hype or speculation. If this video added value, subscribe to the channel and press the bell icon to receive future educational releases. Your support helps keep this content independent and informative.